So guys, we'll let everybody trickle in. They know what time it is and we're all grown. We don't start for another minute, so I'll give everybody 2 minutes.
So you should jump in.
Don't mind the background noise. Dan's just finishing up another call next to me. I am recording this. So as I did last week, we'll put together a nice 5-week series. High compliments to Jeff Sigworth for last week. It was really though, Jeff, it was highly informative. We got a lot of people in gear. I think the more we get to hear about the simplicity of advanced markets, right? Sounds like an oxymoron, but they really are simple when you break it down and what they
super simple.
So without further ado, guys, welcome. People will be popping in. I'll be admitting them, but I'm going to turn the floor over to Jeff Sigworth so we can dive right in and have some quality time for Q&A when he's finished.
Do you guys, I just plugged in my phone in it. Do you guys have any questions? So last time we kind of went through what an IUL is, what it's not. It's not the Swiss Army knife of all insurance products. It is. Who remembers exactly what an IUL is? It is
Indexed Universal Life.
Well, it is, but what's the purpose of it? There's only one
retirement.
Purpose. That's it. Good job,
Yeah.
Stephen. Tax-free retirement. It's not, the death benefit is ancillary. It's probably a distant second or third. Okay, for what the IUL does. But the first and foremost, the only reason you're going to sell an IUL is for tax-free retirement. Okay, then we went into how to find IUL clients. Those that aren't getting a match on a 401k, those contributing over and above their match on a 401k. That's when your spidey senses should go on full alert. All right, go ahead, Stephen.
Was just wondering if somebody has a 401k, can they transfer that money to an IUL without it being taxed?
No, nope. 99% of the time when somebody has a 401k with their current employer, you can't touch it. Maybe if they're 59 and a half, if you could do that, I wouldn't be sitting here. I'd be retired. Okay, I would. It's truth. I would be. I'd be retired. But you would be commingling funds at that point. You would be commingling qualified and non-qualified funds. So what we're talking about is just the amount you're contributing, the contribution amount we're going to reallocate and account for taxes. So great question though. Yes, Shelley.
So I have a friend that wants to do an IUL.
Okay. How old's your friend?
He's 62.
That's too old. It's not an IUL candidate.
Okay.
Because they've missed. So an IUL is for tax-free retirement, right? We've missed the accumulation years. I'm an IUL guy through and through, done 700 on my own pen. Like I love IULs. That's not an IUL client. If you're looking for cash accumulation, you would go like Advantage Plus 2 with Foresters. You would go par whole life. The cutoff is around 50, 55 years old. Anything other than that, it's not an IUL client.
Okay, so I still have a question though.
Yeah.
Because this came up in the conversation. So he says that the doctor told him that, so they're telling him that he might have lupus, but they haven't diagnosed him with lupus, but they're giving him medication.
Gotcha.
So in that instance, if that would ever to come up with somebody, what would you tell them to do about it? Because in the first case, they're telling him, the client, that they're not sure what it is, that they haven't a prognosis, but they're giving him some kind of form of medication for something. So what would you do if somebody came to you and said, well, I want to do an IUL, but my doctor says they don't know what I have.
Did the client really come to you and say, I want an IUL? Or do you want to sell them an IUL?
No, he came to me because I told him about an IUL.
Okay.
And what it could do for you.
Yeah.
And so
I would probably do a participating whole life first. Second, I would probably do a risk assessment. I'm the wrong person to ask for. To ask about health. I've only worked with young, healthy people in my 13 years. Okay. I've only worked with law enforcement and corrections people that usually retire by the age of 55. So when somebody says, oh, somebody's got X, Y, and Z, what product, where to go? I don't know. I'm not very well versed at that.
okay.
Because in my career, if somebody was older than say 55 or so, it was an annuity sale for me. They were retiring, I was moving their 457. I don't have a lot of experience with older, unhealthy people, just the way my career shook out.
Okay, so he has like 10,000 that he wants to put into this. So that's still not
okay.
enough.
And I'm going to tell you who on this call knows why. We know that 62 is too old for an IUL because of the cost of insurance, because they've missed the accumulation phase. And we need to get that. And when we do advanced mechanics, we'll get there. We need to put that thing in a positive arbitrage environment where the cost of insurance actually goes to zero sooner than later. It's very hard to do with a 62-year-old. Why would most clients older than 25, I do not like a dump in to an IUL on clients older than 25. Why is that?
Is it the same as for like the DFL, or would it be different for?
Yeah, it's pretty much the same.
IUL?
So it has different circumstances, right? So the problem in DFL is we're trying to get term to give enough death benefit so the contract doesn't mech. Here, we'll find the death benefit by doing minimum death benefit, maximum cash value, which I'll go over here in a second. But what if that client at 62 years old gets floor 2 years in a row? That's going to screw up that illustration faster than you can say screw up, because now compounded interest is thrown off. Now at 62, the cost of insurance is so high, you're going to have complete egg on your face, Shelly. So with a dump in, with somebody that's 62, participating whole life is a way to go. And I'm going to tell you, before Mike and I started working together about a year ago, I was like, par whole life, screw it. I don't want to learn it, nor do I, I'm telling you, it has a place, and that's exactly where that place is. Okay. So it's a par whole life. Check out Advantage +2 with Foresters. If you need help, shoot me an email.
Hey, Jeff.
Yes, sir.
This is Bobby. I have a quick question.
Hey, Bobby.
I have a situation with a client that he wouldn't qualify. He's a disabled veteran, and he wouldn't qualify for an IUL.
Yeah.
And
Where are you going?
I shifted to his children, and I wrote the IUL and still achieved his
So where are you
financial
going?
strategy. And I just utilized the child's health, which gave a very low cost of insurance. And I was able to front load the policy in a manner that the illustration was really, really fabulous.
Yeah. Awesome.
And so in a situation with a 62-year-old, wouldn't the potential therein lie where you could do the exact same thing? I mean,
You could. It depends what their goals are, right? At 62 years old, even if you put the insurance on a child, it would still, what are you trying to get out of it? You're not going to get $40,000, $50,000 a year in retirement income unless you're coming with some serious premium.
so then if the money is there, then the age is really irrelevant so long as he has 8 to 10
It's true.
years.
It's true. But how much
And
premium
the
are we
money is
talking
there.
about, Shelly? Shelly, on a monthly premium, what are we talking about? And here's the thing, and at 62 years old, when are you going to retire? Right? Because even if if that person retires at 75, now we've only got 13 years of accumulation. So unless we're putting $2,000-$3,000 a month away on a 7-year-old, probably doesn't make sense. Okay. All right. Let's get into this. So today we're going to go over the presentation, how I present an IUL to a client. Some of what I'm going to do is client facing. Some of what I'm going to do is not client facing. So what I'm going to do is I'm going to pretend that we have a client, and I'm going to get some baseline information and make some assumptions. Then we're going to run an illustration that we wouldn't do in front of the client. And then I'll show you how I present that illustration. You guys cool with that? All right. So with every, I need to share, Mark.
I get you there.
Thanks, buddy.
You should be good now, Jeff.
There we go. I got it. All right. So we're going to go here. We're going to go to a compound interest calculator for investor.gov. Okay. Now we're going to make some assumptions about somebody's current investment. So the initial investment is 0. So we're going to look at this day forward. So who wants to give me a potential client?
You can use me.
Well,
Say that again.
I will.
All right, go ahead, Shelley. How much are they putting away a month?
250.
$250 a month. And how long are we going to put that away?
For 20 years.
20 years. It's going to be a tough one. So how old? So somebody who's 40 years old, 45 years old at $250 a month.
Mhm.
Okay. What estimated interest rate do you think we can get with over 20 years in a 401k? What would you be happy with?
6%.
I agree with
I
that.
don't
So
know.
let's say, I agree. I think 5-6% is realistic, but let's say 8. Nobody's going to argue with that, right?
Right.
And let's say we're not going to vary it. So we're going to calculate that. I want you guys to write this down. $137,285. Okay.
137. 137.
So do you think you're going to have more or less than $137,000 in an IUL?
More.
You're going to have way
Uh-huh.
less. From an accumulated standpoint, from a cash value, you're going to have a lot less. But we're going to turn it into more income. I'm going to show you how. Now, who knows on this call? So let me ask you guys this question. If I said, here's $1 million in a 401k, and I said, here's $700,000 in an IUL, what would you take?
Normally people would take the 401k.
Yeah, but keep that in mind. I want everybody in this call to remember, Shelley said we're going to take the 401k. Right? Now, who here on this call knows how much a financial advisor, a certified financial planner will tell you can take out of the 137,285 for the rest of your life, so you'll never run out?
4% a month, a year.
That's right, 4%. Okay. So 137,285. Let's call it 286. We'll give them an extra dollar. 137,286 times 0.04. It's going to give them write this down, $5,491 a year. Not very much. Not very much at all. Okay. So we're not earth shattering here. This is I don't even know if I'd take somebody at 45 years old with $250 a month in an IUL. I just don't think it's an IUL play. So we'll have that. Now I'm going to go in and I'm going to run the illustration. This is not client facing. I would do this behind the client's back. What state are you in, Shelley?
Tennessee.
Tennessee. You don't have a Tennessee accent. You're from the north. Ohio, West,
Indiana.
Indiana, Ohio. I was close.
I know I need to get a little bit more twang in my voice.
Yeah. Is this a male or a female?
Female.
All right. We'll go Tennessee. You're my neighbor.
Yep.
I'm only like 30 minutes from the Tennessee border now.
Really?
Yeah.
Well, are you having a party?
Just over the mountains, just over the
Yeah.
mountains.
Just over the mountains. That's right. All right. So here we are. Here's the nuts and bolts of this. You got a 45-year-old female. Always, always, always. I'm going to tell you guys, if you go to solve for something and max accumulation and income doesn't work for you, call me or shoot me an email. Always max accumulation and income. Okay? Always. We know the premium. We're going to solve for face amount. Now, to be fair, we can't take the whole 250 because that's qualified funds. So we're going to take $200 a month. Okay. We want to be as apples to apples as even as we can be. We're gonna have them pay this in until they're 65. We're gonna have them start at 65 years old. We're gonna have them pay until they're age 100, so they never outlive. We're gonna use the 7702 rates. We're gonna do option B to A, increasing the level. We're gonna level that out when they stop paying at age 65. And we're gonna use 100% of the Barclays. Okay? Guys all follow that.
So
Can
you don't
you-
have,
Can
ahead.
you just go back and show the death benefit, what that one looked like?
We don't know yet. That's just a, that's.
Oh, I
just-
mean,
we don't
I'm
know what it
sorry,
is.
where it says the option, I'm sorry that you chose, my bad. So it says
Death
varies,
benefit
option B to,
B to A. So we're gonna do an increasing death benefit, which starts out even lower than option A. The
Okay.
reason we want the death benefit to start out even lower is because more money gets accrued in the cash value portion of it. At
Okay.
option A, when we stop paying, not when we start taking income, but when you stop paying, because there might be a 2 or 3 year gap where you might have somebody stop paying and taking income. You want to level it
Okay.
off. So why do we want to level it off? What happens? Especially as we get older. That's your hint.
Cost of
cost of
insurance.
insurance.
Cost of
Yeah,
insurance.
we don't want the cost of insurance to keep growing in perpetuity. Then Dave Ramsey's right. Okay. So what we want to do is we want to level that off when they stop paying, so that cost of insurance gets frozen. We're ready to roll. Anything else? Good question.
so do we always put that B to A then? For every,
Not 90% of the time. There's some time that you might want to run option A on a younger person. You know, and option A versus option B isn't that big of a difference. You might as well get paid. You can do your charity work on Sunday, sometimes on Wednesday nights, but most of the time you're going to do B to A.
okay,
Steve, you had a question, buddy. I saw your hand raised.
Hey, Jeff,
Yes, sir.
checking that box, the 7702 is
Mhm.
always correct, or?
Always. It would be almost criminal if you didn't select that.
So that's even like in 6 months, 12 months, is that still gonna be?
So what happened in 2020, in December of 2020, the federal government passed a rule that allows 40% more cash value into life insurance policies. Okay, that's why we're not allowed to say the 4% anymore. That whole 7702 change is what changed a lot of things in our world.
so
Hey, Jeff.
Yes,
oh,
sir.
Yeah, Mohammed, can you go a little bit on that, the statement you just made on
yeah,
the 7702?
Section 7702 of the IRS code is the portion of the IRS code that allows cash value to live inside of a life insurance policy. Okay. So back in 2020, the federal government changed the limits. There's what's called corridors or silos inside of life insurance contracts. Okay. Inside an IUL, they are allowing and allotting for 40, on average, 40% more cash inside of a contract
Gotcha.
per death benefit. So I'm telling you guys, with all the stuff that's happening with our deficit, our national debt, our deficit, and they're telling us that they're going to allow us to put 40% more cash into a life insurance policy and we can usurp taxes. I'm not stupid, but I don't like taxes. Who on this call likes it?
now,
Right. So the fact that they're allowing us with the economic situation and unfunded liabilities and that whole thing, that they're going to allow us to put 40% more cash in a life insurance policy, the writing's on the wall. Okay. I mean, you can do what you want to do, but I know what I'm doing. Okay. And here we go. We hit the illustration. Okay. So now I'm back in front of the client once this pops up. Okay, so I'll stop share, kind of give people that break. We're back in front of the client now. Now I'm going to do the presentation. So I'm going to do this presentation. Anybody want to, Shelly, you want to be my guinea pig, or anybody else want to be my guinea pig?
sure,
All right. All right, Shelley. Last time we were together, you told me that you were putting $250 a month away into a 401k. Is that correct?
Yes.
Okay. Now, what I'm going to go over here is an IUL, and I'm going to use a 4-letter word, so don't fall out of your chair. Okay. That 4-letter word is life. Okay? I'm going to show you an indexed universal life insurance policy. Before you say, "Oh my God, life insurance, bad investment," let me tell you a little bit about the people that use indexed universal life. Have you ever heard of Magic Johnson?
Yes.
Do you know he found out he had AIDS or HIV because he was taking an exam to do $1 million a year policy?
No.
That's how he found out he had the HIV. Have you ever heard of Jim Harbaugh?
No.
Jim Harbaugh is the head football coach of Michigan, which I'm a Penn State guy. I got my kids' college on now, but I'm a Penn State guy. And Jim Harbaugh hasn't been doing that great. But do you know he has the biggest contract in college football?
Wow.
Even though hasn't been doing too hot. Maybe this year he did okay. But he has a bigger contract than Nick Saban, probably the best college football coach. Do you know why he has the biggest contract?
Why?
Because he negotiated an IUL in his contract. Okay. And it has more worth than any of the other contracts because of an IUL. Have you ever heard of Ray Kroc?
No, maybe I'm the wrong person for this.
No. Ray Kroc is the guy who started McDonald's and buying he bought the land that McDonald's were sitting on.
Okay.
I'll get to more that you know. And he bought that first piece of property with cash value life insurance. Have you heard of Walt Disney?
Yes.
Walt Disney started Disney with cash value life insurance. Have you heard of J.C. Penney?
Yep.
Yep. During the Depression, he paid his employees' income with cash value life insurance. So it's been around forever and it has a negative connotation. Okay. But I'm going to show you how it's going to work in your favor. Is that okay?
Yep.
Now the IUL, it does 4 things. Protects your family, protects your income. It comes with a death benefit. It protects you from market risk. You're never going to lose money. It protects you from unnecessary taxes. Okay. And last but not least, the last thing it does is 180 degrees opposite the first thing. The first thing, you die, you hit by a bus, right? Bad day. What if you live until you're 98? Hey, do you have any protection in your 401k from outliving any retirement dollars?
No.
No. So, okay. Now, as I go over this IUL, okay, I want you to have this rolling around in your brain. And guys, I've gotten more out of this from clients and agents than anything I've probably ever spoken ever in my life. As I go over this IUL, I want you to have this idea that this is like a Roth IRA married to a life insurance policy where you can't lose your interest, your principal. Okay. So the first thing I told you is we're going to protect your family and protect your income. From day one, you have a $50,000 death benefit. That's actually the lowest death benefit this product is allowed. Usually it's a strange, uneven number. This is one of the very few instances that it's not in my case. But that $200 a month, I didn't pick 250. Do you know why I didn't pick 250, Shelley?
No.
Because the 250 that you're putting away in your 401k is actually pre-tax dollars. So what we're going to do is we're going to actually let this go back on your check. You're going to pay some taxes. And so you can still go out to the pizza factory on Friday night. I'm going to ramp that down to $200 a month. I'm not here to reach in your pocket and create another bill. I'm just here to provide as much value from a financial wellness standpoint as possible. Okay.
Okay.
So that $200 a month gets you a $50,000 death benefit. And you're probably thinking that's a lot for a $50,000 death benefit, right?
Yep.
We want that death benefit as low as possible because the goal here is to outpace your 401k. So we're disguising your retirement plan as life insurance, and we're using life insurance to make it tax-free. But that $200 a month gives you a $50,000 death benefit from day one. Now, let me ask you, Shelley, if you pass away, what does your beneficiary get from your 401k?
Nothing.
Well, they would get the value, right?
Yeah.
But what else? What would happen? They'd get a swift kick in the shorts right after.
Yeah.
Right? They'd get, IRS would say, give me the taxes. This is tax-free, an enhanced death benefits that's tax-free from day one. So I protected your family and protected your income. The second thing I'm going to do is protect you from market risk. Okay. We have a cap and a floor. Now, I'm going to take you back to this section and explain how this works. Okay. We have a cap at 12 in this case and a floor of 0. See this? Cap at 12 and a floor of actually 0.25. So let's go back 20 years. See this 19, this minus 19.74?
Yep.
You know what was going on 20 years ago when that happened?
9/11.
It was a dot-com bubble. Might have been 9/11 too. It was dot-com, 9/11. Yeah. How much did my clients lose at that point?
Nothing.
My clients didn't lose a dime. Next year we hit our cap. Next year we hit our cap. We had full participation cap. Look what happened in 2008. Market lost 40%. How much did my clients lose?
Nothing.
Didn't lose a dime. So you can kind of see here, sometimes we'll have full participation, we'll hit our floor, we'll hit our cap. The 10-year average, the market's, the S&P 500 has been on fire for the last 20 years, okay? 14.5%. But look what my clients did, pretty darn good at over 9.5%. But if you look at the 20-year average with those losses, 7.38%, we beat that at 8.08. And sometimes we combine it with this uncapped strategy as well. Now, let me ask you, Shelly, can you time the market?
Nope.
No. Do you go in and manage your 401k on a weekly, monthly basis?
No. No, I do
So
not.
a sit it and forget it policy, a strategy like this, where you participate up to a cap, but you have downside protection, something that you would be very interested in, right?
Absolutely.
Okay, cool. So that's how we protect you from market risk. The third thing we do, now you're probably thinking, all right, Jeff, you got me this death benefit. I understand it's life insurance. You protected me from market risk. Okay. Show me the money, right? It's Jerry Maguire time. How do you show me the money? What we do is you buy this death benefit. Make no mistake at all. You're buying this death benefit. Okay. But at 65, when you're going to retire, do you want or need to pay for a big death benefit? Where are your kids going to be?
They're going to be gone. They're
They
going to
better be out the house, right?
Yeah.
Where's your mortgage? Right, it's all paid for, or you're paying mostly principal and not interest, right? So you don't need to carry a big death benefit. So what we do is we borrow from the death benefit, use the cash value as collateral, okay? And because it's a loan, because you're borrowing from the death benefit, you're giving yourself a loan. Loans aren't taxed in this country. Did you know that? That's why the Boston Tea Party happened. England started taxing our loans. We got pissed. Okay. So we're borrowing from ourselves, and that amount you're borrowing, it's going to be around $9,000 to $9,500 a year. Okay. And that's tax-free. And then there are safeguards in this contract that make sure you don't run out of money. So I ran this until you're 100 years old. Okay. In fact, your death benefit probably won't go any much lower than like $65,000. You're gonna have a permanent death benefit. Now, let me ask you something, Shelly. 9373. What number did I have you write down?
5,491.
Yeah, I got it right here. You're gonna have to pay taxes on that, aren't you?
Yep.
Tennessee doesn't have state income tax, but you will be subject to federal. So what do you think? Maybe a 15% tax bracket would be safe?
Yeah.
That's even today's rates. We know they're probably going to go higher. So let's times that by 0.85 because we'll only be able to use 85%. So that's $4,600 a year after taxes, Shelly. So does $4,600 a year with no death benefit or maybe a really expensive death benefit work for you? Or does $9,300 a year work better for you with a permanent death benefit? Which one works for your family?
The 93.
There you go. Can you grab your license, please? Okay, I'm in the app. Okay. It works better with better numbers. That's not the best example, but when you do that presentation, you drop the mic. It's done. Okay, that's the power of an IUL. And if we did it a little bit more, you know what? It could come out with, hey, your 401k is going to pay you $20,000 a year. And this is going to pay you $41,000. Okay. Plus, not only that, the more tax-free income you have in retirement, what else is tax less?
Social Security.
Social Security. Steve's my guy here. Steve's on point. Like everything I'm saying, I can see him shaking his head and nod. Yeah, your Social Security is tax less, and you have a permanent death benefit. So which one works better for you and your family? I've never had anybody say no to me in that. Okay. What questions do you guys have?
Jeff, I just gotta say, that was so smooth. I was like frantically writing down everything you said. That was really great.
And something I didn't do that I normally do. I've been so concentrated in DFL for a while, is I'll go back and I'll say, okay, Shelly, does your 401k protect you from outliving your retirement dollars? No. Does your 401, does deferred comp, and I'm using that word purposefully, does deferred comp protect you from taxes? Does your 401k protect you from market risk?
No,
Does your 401k provide you an enhanced death benefit?
no,
So I think you can see the value of the IUL over the 401k, right?
absolutely.
And it's going to pay you, but wait, there's more. It's going to pay you more money and give you that permanent death. Okay.
Mhm.
Doug, you present it like that, nobody tells you no. Yes,
Jeff, real quick, those are fantastic questions. Do you mind just going over those slowly again so everybody can write those down?
Okay, so questions-based selling, right? So we do, does the 401k provide you an enhanced death benefit? No. What does your beneficiary get if you pass away?
It's 401k.
Whatever's in the 401k and a quick, swift kick in the shorts, because you have to pay taxes on. Okay. Does a 401k protect you from market risk? No, it doesn't protect you from market risk. It's cyclical with the market, goes up and down. Okay. The third thing, does deferred compensation, what are you deferring? You're deferring taxes to later. I've asked my parents this. My dad's like, Jeff, in the early 70s, people didn't have the extra money to put in the market, okay, because taxes were so high. So what they did is they said, hey, we'll give you a tax break, put this money into an account where you can invest, more people will put money into the market. And then when you're in retirement, your tax bracket will be lower, you'll pull it out. Makes sense. We're in the third or fourth lowest tax bracket in the history of the United States right now. Even if taxes go up, it still doesn't make sense. And I can show that to you if you guys want to see it mathematically, let alone if taxes go up. And the last one's 180 degrees opposite the first one. The first one is, God forbid, I find them still on the way home and these moonshiners, get me, right? But what if I live until I'm 98 years old? Does a 401k protect you from outliving any retirement income? It doesn't.
Thank you, Jeff. Excellent.
Yep. Julian, you're so nice and polite there to raise your hand. You got a question, buddy?
I do. So
Yes, sir.
So I'm glad you brought up 7702, and I have kind of more of a broader question. And
Yeah,
when you referenced a lot of the examples, Disney and some of the others, I'm familiar with that, but a lot of those individuals will talk about cash value and whole life policies. So the argument that you're making against 401k is really, I think it stands on its own, right? I don't think that there's it's not comparable, but in our industry, there is a prevailing argument. I mean, you talked about Ramsey, but I'm just talking about now whole life versus IUL, right? And so as I think that when we at Symmetry have, I believe National Life Group is the only carrier in-house that does both IUL and permanent under the same roof. So I think that a lot of times they tend to be, I'll just say, unbiased. And I'm not suggesting, Jeff, that you're biased. So how do you raise the argument about if you don't overfund it and you talk about that cost of insurance component, and if you don't design it, you're using Barclays. I like that index by and so how do you deal with that argument? Because I hear it, I've been hearing it so much over the last year.
I don't deal with it. I don't deal with it. And there's two things to talk. I don't underfund an IUL. There's only one way to run an IUL, and it's minimum death benefit, maximum cash value. That's it. End of story, done. If you do that, I will stand on the steps of the Supreme Court and I got your back. If you don't, I'll be the first one to put two hands in the small of your back and push you to the wolves. There's only one way to design an IUL. And if you don't design it that way, I think everybody should come behind you and replace it. It's only one way to design it. It's minimum death benefit, maximum income, maximum withdrawals. That's it. I'm not a fan of National Life Group's IUL. It's not that great. So that's first, is if you were gonna, a situation where you want to find a different solution with maybe an increased death benefit with cash value, then go to a participating whole life and play with the FPUAs. Okay.
Okay. Now, is there ever a scenario where you use any of the other crediting strategies? Like, I've never done it, but is there a scenario where you've ever used anything outside of Barclays?
Yeah. So on my personal IUL, I have 80% Barclays, 20% S&P, because the Barclays doesn't beat the S&P all the time.
So would you at some point do 50-50, or would that, you think would be?
You could do 50-50. It's whatever. I think Barclays, because of the uncapped nature of Barclays and the high participation rate, I think over the period of time, you're going to see the Barclays outperform the S&P. But with that said, I like 80-20, 75-25. That's where I think the math falls out. So that's first. The second one, when comparing whole life to an IUL, if you take a client under 50 years old, okay, and I've said this to people too, okay, I'll put $500 a month into an IUL right now, and we'll give it 10 years, and you can put $500 a month, Julian, into a participating whole life. At the end of the 10-year period, whoever has the most cash value has to give ownership to the other one. Nobody's taken me up on that bet yet. Okay. Over a 10-12 year period, an IUL is all other criteria even. The IUL is going to outpace the participating whole life. It's just the nature of the IUL and the way it's set up. Now, the participating whole life is great from, so let's use the infinite banking concept, because of the predictable nature of it. Okay. If I tell you, you might be able to pay off your bill in this time, you lose a little bit of credibility. But if Betsy can go in and say, you know what, Shelly, you're going to pay off that bill June 4th of 2024, done. If you don't do anything else, there's a lot of credibility in that. But then IUL, you can't do that. Okay. And that's the reason why I like participating whole life and some of the guarantees. And that's why I like an IUL for tax-free retirement. And I think they both have their place.
Cool.
Good
Thank you,
stuff.
sir.
Well, yes, absolutely. What other questions?
Hey, Jeff, Mohammed.
Hey, buddy. Yeah.
Question. If you had, because when you do the minimum debt benefit, maximum cash value, let's say you're working with someone younger, they say, listen, I want to give myself a raise every year. So they start up, let's say $300 a month.
Yep.
You set it up that way. If they come back to you, because the guideline, annual premium is
GPT.
locked in, you're not going to be able to do
I agree.
without restructuring the plan. Can you create a little bit more room? So at least if they want to do $100 more.
Nope. Because it's like this. Would you run a marathon? Okay, Mohammed, let's run. You and I are going to run a marathon. Okay. I have bad knees, so I can't do it. But let's pretend I have good knees. You and I are going to run a marathon. You're going to start that marathon for the first 3 years with a 50-pound backpack, and I don't have any. Okay. So leaving that room is handcuffing and handicapping I got a train going on. That never happens. It's handcuffing that policy owner because the cost of insurance is high. Now you're messing with the sequence of returns, because now that compounded interest is off because you're paying cost of insurance so much in the beginning. And I'll catch up. One, they're already rendering it inefficient by not putting that money in. Two, if they don't ever put it in, now you've got a blown up IUL that's basically worth this cup. Okay. So what I do to clients is great. We're going to set it up, minimum death benefit, maximum cash value. If a time comes where you want to put in more, this is what we're going to do. we're going to do an in-force policy illustration, and we're going to restructure the policy at that point. And if you know, you're sick, you're unhealthy, we'll do it on a spouse or a kid. But I do not ever like to render a policy inefficient, because a lot of people you know, they like to talk. Oh yeah, I'm going to put $1 million in it in 6 months. Yeah, it doesn't happen. Okay. And if it does, we'll deal with it at the time. If they're still young enough and healthy enough, we'll do an in-force policy illustration and restructure the contract.
Okay.
What other questions you guys have? Good questions, by the way.
Hey, Jeff, this is
Yes, sir.
Steve. What years typically is the premium that you've put in roughly going to equal the cash value? 7 to 10? Is that what
No?
you're
So
saying?
so with F&G, that used to be a 10-year surrender period. Now it's a 15-year surrender period. But what I'm going to show you is it's negligible. Okay, it's really negligible. So look at 15. You've put in your cash value is 52,475. Your surrender is 52,400. Right? Even in year 10, 27,266. What are we talking here? $1,600. It's the surrender value is very negligible. And then at year 16, your cash value equals your surrender value. Now I'm going to tell you guys something. I'm going to tell you a trick. This was the aha moment for me back in the day. I gotta move this. Account value is what your house is worth. Surrender value is the equity you have in your home. So at year 16, you own your home. Okay. Now, what happens here when you start taking loans against this? It's just like a reverse mortgage. It's the exact same math that's going on. Okay. You're giving up your equity in your home, but the value of the home keeps still going up. Okay. You're borrowing against the death benefit using the cash value as collateral. Now, I want to point something out to you guys. Did that make sense to you, Steve? Now, this is gonna, okay. Look what happens here. Right here, let's call it, let me, easy math. I went to public school in Pennsylvania, so bear with me. 104, 119. Okay. There's about a $15,000, $15,400 difference. The cost of insurance when this lady's 67, they're only paying insurance on $15,400 there. Okay. So the cost of insurance on a 67 per thousand is huge, but it's only on 15 grand. Look what happens the next year. The death benefit or the cash value, I'm sorry, when the cash value in the contract supersedes the net death benefit, cost of insurance goes to zero, because the net dollars at risk, there's no net dollars at risk. So the insurance company, when a client passes away, beneficiary gets the death benefit. This goes back to the insurance company. So if you had a 62-year-old, how long is it going to take to get to that standpoint? That's going to eat up cash value because cost of insurance is so high. So that's what I was talking about, Shelly, when I was saying a little bit too old. The accumulation phase is over, right? Got to go to a par whole life. That's not the same, because in a participating whole life, the way it works, there's silos here. There's these vertical silos is what I call them, or corridors. Those corridors and silos in a par whole life look like this, because the cash value has to meet the death benefit at 121. We don't have that. Okay. So that's really the difference between a par whole life and an IUL. And I hope that cleared up a lot of things.
Alexa, make an announcement.
Yes. Betsy's making an announcement.
She's talking to her son that's homesick.
Okay.
Oh,
Go ahead.
Sorry, I'm so
That's okay. Did that clear up a lot of things for you guys on how they work and where we're going? So that's, and guys, I would keep it that simple on the four things.
Hey, Jeff, quick question.
Yes, sir.
I have a client I sold a IUL 2 years back, and he and I was talking last week. He told me he's going to be selling his home this summer.
Okay.
And when he sells his almost the proceeds from the home, he say he has room of up to $50,000 in his IUL. He want to dump all of that in there. Would that be wise?
You got to get an in-force policy illustration. You have to find out exactly where. You have to find out exactly what the room is. You want to drop the death benefit first to as low as it can be, and then determine what the room is. And that's how you're going to word it to the what carrier is it with?
Was with National Life.
Don't write National Life Group IULs anymore. Please don't do it. They're just not a great IUL carrier. Term's great. The IULs are not great. But get an in-force policy illustration. Lower the debt. Ask them how low you can lower the death benefit based on the cash value, and then determine how much room is in it. Okay, that's going to render the policy as efficient as possible.
Okay. Or would you recommend and just write them a brand new IUL with FNG?
How old is he?
He's 37.
How much premium a month?
He was paying about $300 a month.
I'd look at the illustration and see how long it takes to what his surrender value is, and do all the math on that.
Okay. All right. Thanks.
Yeah, of course. You guys know why I'm not a big LSW fan? National Life Group. Okay. What's National Life Group's cap on their IUL right now?
It's about 5. I think 5.16 or so.
Yeah, it's not. They don't have a competitive cap. Okay. I'm winking here. They're free living benefits. They're not free. They're robust, but they're not free. Okay. They have the highest cost of insurance in the industry. They have a low cap, and they don't have a capped loan rate on the exit strategy. Okay. So it's just, we'll blow NLG out of the water every day of the week with F&G. It's just not a competitive product.
Yeah, definitely. It's just their term policies I like because of their living benefits.
Yeah,
I had a
term
client
policies are great. Terms great. Their terms phenomenal.
Yeah.
When it comes to IUL, it's not the play.
Okay.
Yeah. Fortunately, it's not.
All right.
What other questions do you guys have? I know that's a short segment, but literally that presentation takes 20-25 minutes before questions. Okay. And I'm telling you, I've literally done this with an agent. You guys know I've worked with law enforcement and corrections for a long period of time. I was training an agent, and I literally said before the guy knocked on the door, because we were in a home for like 2 hours right before this. And I said, Kenny, I got my timer set for 30 minutes. You better be in the app by 30 minutes. If you're not, I'm getting in the car and this is going to go off. He's like, and I'm like, you should not spend hours upon hours upon hours going over the IUL. Protects your family, protects your income, protects you from market risk, protects you from unnecessary taxes, protects you from outliving. Can the 401k do those? No. And we assumed that $5,000 in our illustration or in our thing, we assumed an 8% return over 20 years. That's pretty damn good. That's hard to argue with. Okay. Can you time them? Here's a couple things I tell clients. I'll use Shelly. Shelly, I'm picking on you today. Is that okay?
That's fine.
Shelly, let's pretend it's September 1st of 2008 and Jeff Sigworth's going to retire. Okay.
Okay.
So what happened? So Carissa gets on the phone and goes, "Hey, Mark, I know you've known Jeff for a little bit. Maybe come out to the house and play cornhole, margarita machine. All right, Jimmy Buffett playing. Hey, Betsy, you work with Jeff a lot. Come out to the house. You know, Jeff's going to retire December 31st. Well, what happened in October of 2008? Does Carissa get on the phone and say, "Hey, Mark, hey, Betsy, no margarita machine, no cornhole. Jeff's got to work 5 or 6 more years." Okay. My clients don't have to make that call. Okay. Here's another one. Protect you from market risk. Here's another good one. Let's play a game. I'd say this to clients all the time. Shelly, let's play a game. Okay.
All right.
You're in the market.
Okay.
I'm in the index. So I don't lose, right?
Okay.
So let's pretend we both have $100,000.
All right.
So the first year The market loses 10%. What do I still have?
All 10%.
No, I still have my 100 grand.
Oh, yeah.
Okay. So if the market loses 10% and you're directly in the market, what does your 100 grand now change to?
90.
90 grand.
Yep.
So the next year, the market goes up 10%. What do I have?
You have 110.
That's right. What do you have?
I still have, well, I'm back at 100, I guess.
No, you're not.
99.
You're at 99,000. Wait, welcome
Oh,
to indexing.
okay.
By the way, Shelly, what's your social security number? Because I'm in the app. Okay. Welcome to indexing. Okay. Those little things, if you can get people to interact like that, they're like, oh yeah. Right. Okay. Those little things, if you can get them to see the light and go, oh, you know what, you're right. Okay. What other questions do you guys have? Any
Jeff,
other
one more-
questions,
one-
comments?
Jeff, one more
Yes, sir.
question. So when I noticed one thing that you did, when you illustrated out the income, you actually did it from, I think it was hypothetically, let's just say 60 till, I don't know, 100, let's just say.
I did 65, I did age 65 to 100. Yes.
To 100. Now, I believe that the beneficiaries do not receive the cash value, right? That's correct.
That's
right?
correct.
So
In zero circumstances
Right.
does the beneficiary receive the
Right.
cash.
I knew that. So then for the purposes of, and I know we might be playing actuarial science here, but
Mhm.
would you not illustrate from, let's say, 60 to 85 so that you would try to allow for more maximum return?
No, I'm
No?
I'm
Okay.
gonna beat no, and the reason being is I'm gonna be as conservative as possible. I could cook that illustration, Julian? Dude, it would look phenomenal. I could do things right now. I'm not even gonna tell you guys how to do it because I don't want you doing it. But I could cook that illustration. You guys would be like, oh, great. I mean, phenomenal. I'm being extremely conservative because I want them to know, hey, if I take 9 grand out of that thing a year, I'm not gonna run out of money.
Mhm.
Okay. They could be irresponsible, overloan the policy, sure. Right. But I'm not comfortable doing that. Can I make it look better? Sure. 100%. I can do a bunch of things to make it look better. Now let's go back to the illustration, Shelly. How much? We had 137,000. How much is in here when we start taking income at 65? 89. Do you want 89,000 inside of an IUL, or do you want 137,000 inside of a 401k? So that's why we never illustrate. That's why I always illustrate income. Okay? Because you could say, well, can you take this $96,000 or $89,000 and run with it? Could this client at 65 years old say, give me the $89,648?
Yes.
Yes.
They could, but what's going to happen?
Taxes.
How much taxes?
50%, I don't know.
41 grand. They're going to pay taxes over and above everything they put in over their cost basis. So they're going to get a tax bill for 41,648. Okay. So that's why you never, ever just illustrate this number, because using the loan provision, look what I can take my 90, let's just 90 grand because it's easy math. In 10 years, I got 93,000. I got this tax free and I turned it into a heck of a lot more than 90 grand. And I'm only 75. My old man's almost 79, doing great. Okay. We can take that big chunk and turn it into more over time by taking loans.
So I had somebody ask me,
Mhm.
so if they were to sign up for the IUL, I know it's that 12 months that they cannot touch it, right?
Well, no, they can touch it in 12 months. If there's cash value in it, they can borrow it out.
Oh, so they don't have to wait for 12 months
No.
as long as they have cash value. Oh,
Yep.
okay.
You don't have to wait a year. No, you can go ahead and borrow money out if you want. It says it right on the portal. You can go in and you can see how much you can loan out. Yeah. You don't have to wait. Maybe that's some one-off carrier that I don't know about, but yeah.
Oh, okay.
It's like that on annuities. On annuities, can't borrow out sometimes in the first year, but not in IULs.
Oh,
So next week, we'll go over objections. Next week, we'll go over the objections that I've had, common objections. The IUL is my favorite part. The objections is my favorite part. I love it. So bring your objections. That's my favorite part. What you guys have anything else? We got 5 more minutes. What else do you guys have?
Jeff, I really like that statement that you made about the IUL is like a Roth IRA married to a life insurance policy. And I like halfway remembered it, and I sort of used it yesterday, but I didn't do it 100%. So could you expound on that? If someone says, well, what do you mean? Kind of how do you phrase?
Yeah. So we have a cash accumulation vehicle married to a death benefit. Okay. The cash accumulation, it accrues interest inside of this contract. It accrues interest. You can't lose money though, and you accrue up to a cap. Okay. On the life insurance side, we have to use life insurance because where else can you get that kind of interest rate, have liquidity, and have it be tax advantaged? Tell me another vehicle where you can do that. You can't. So it's like a Roth IRA because it's tax-free income married to a death benefit. If you can understand that, kind of have that idea. And when I mean married, I mean till death do you part, because you're gonna have this sucker till you die. That's kind of what it's like. And people are like, okay, yeah, I can kind of think of that.
Hi, a little earlier you had said, keep it simple and to the minimum, and you went a little fast. My pen was not fast enough. What were the 4 quick things that you kind of always want to mention just to keeping it simple?
4 things. And I'm telling you, I have a whole series, guys, and I'm chomping at the bit to let this out to people. When I get in front of every client, I say, hey, my name's Jeff Sigworth. I go through whatever I'm there for. Okay. I say, my license allows me to do 5 things. Protect your family, protect your income. Notice I don't say protect your mortgage. I've never done mortgage protection, but I don't want to put a ceiling. If your mortgage is 600 grand, now all of a sudden I put a ceiling on the death benefit I can say. Okay. Here to protect your income, protect your family. What's your family worth to you? What's your income worth to you? Your job worth to you? Protect you from market risk. My clients don't lose money. Protect you from unnecessary taxes. This is the one that's not included in the IUL. Protect you from unnecessary interest in debt, right? That's DFL. And then last but not least, I'm protecting you from outliving any retirement dollars. If I can do one, any combination, or all 5, I'm doing my job. And I'm going to try to do it without having you spend 1 additional dollar. Okay. My job is to bring as much value as possible from a financial wellness standpoint. That's how I give myself permission to get into the FIF. Because I just told you, I'm here. My license allows me to do this. Okay. So if I'm going in for QMS or PCS, then I'm going to say, you know what? Tell me about your existing insurance policies. Then I'm going to transition to the other scenarios. If I was in mortgage protection, I probably want the mortgage information first. Okay. If I was going in for retirement planning, I'd probably start at assets and then go to there. Right. So if you can give yourself permission to move forward in every section of your presentation and ask questions, now you're not selling anybody anything. You're just giving them what they need. So in order to sell an IUL, I would say, oh, Shelly, you and your husband have a lot of retirement set aside. Good job. Is retirement important for you guys?
yes, absolutely.
Okay. So let me ask you, do you realize that all the retirement accounts you have right now are subject to taxes in retirement?
No, I didn't know that.
Yeah, like your 401k, your pension, your 403b, your 457, all that, your annuity, they're all subject to taxes when you retire. You didn't know that?
Nope.
Okay. So do you think taxes are going to go down in the future or up?
Well, they're definitely going to go up.
So if I could show you a way where you could still put away the same amount of money, no more money out of pocket, but have a tax favored retirement where you get that income tax free, is that something you might be interested in?
Absolutely.
So what I did is I layered a future pacing question and a trial close to get her interested. That's really important, guys. You guys need to learn the Socratic sales process and learn future pacing questions. What's your life going to look like in the future? What's the problem in the future? And then how am I going to fix it? Now I'm not selling Shelley anything. Now she's like, give it to me. Okay. Because it was her idea. She told me. She said it was a priority for her. I didn't know. Right. Just like debt-free life. If I could show you a way to pay off all of your debts and build wealth without any additional money out of pocket, Shelley, would retirement be more comfortable?
Yes, I'm doing it.
Would you be able to retire sooner?
Yes.
Yeah. See, those future pacing questions. Now I'm not giving her anything she doesn't want or need or selling her anything. I'm giving her what she wants. All right, guys. Next week, objections.
Jeff, thank you so much. And guys, I want you to think about your own retirement here. Make yourself the guinea pig, or pick a friend. If you reviewed last week's call and understand this high level enough to even present to somebody, get all the what abouts, or all the fear questions, the objections. Probably best is to run it on yourself and come up with your own objections or roadblocks, questions, anything, right? And let's hit Jeff with it next week, because once we understand how to present this high level, and B, how to overcome objections, the illustrations we can practice with Ben Holmes over at F&G all day long, right? So please practice and punch in numbers and get in there and really get down and dirty, and we can hit Jeff with those. But just the same, again, we can run that ad nauseum. You'll always have all the assistance you want in the world, right, Jeff? I mean,
that's right. Guys, shoot me an email, shoot me a text. I'll help you out any way I can.
Jeff, I can't thank you enough. Again, guys, what are you, you're head of advanced markets at Quility or something like that?
It's a long title.
That's what I thought.
Director of Advanced Market Training and Sales Support.
There we go. So guys, you've got the man, the myth, the legend right here, Jeff Sigworth. Thank you so much for taking the time. Very generous.
You got it, guys.
Let's do our homework.
I got to run. See you guys next week.
See you next week, bud.